Well, Chinese blue chip stocks have been under pressure as investors lose confidence in the government's ability to respond to an economic downturn. Bloomberg estimates the sell-off has wiped out roughly $5 trillion in value from Hong Kong and Chinese equities since the peak of 2021. Overnight, China replaced its top securities regulator, a surprise move that may signal more aggressive measures by Beijing to stem the capital outflows. To discuss the implications for investors, let's bring in Eswar Prasad, Cornell University professor and the author of The Future of Money. We also have Anthony Sassine, senior investment strategist at KraneShares. Anthony, I'm going to start with you. Obviously, with KraneShares, you've got K-Web there, certainly been affected by the declines that we've seen in overall Chinese equities. As you look to see how the policy is shaping out to create a floor, if you will, on this sell-off, how do you look at the portfolio mix and what's ahead?
Thank you. Never a dull day with China. So the policy has been supportive, for the economy, especially from the fiscal side over the past 2 years. We saw that from infrastructure perspective and also manufacturing, and that helped a lot, keeping the growth at 5%. But that hasn't been effective in actually bringing consumers back, right? So consumer sentiment continued to be depressed in China, especially after 2 years of COVID and regulations, which show some of the internet companies kind of being under the microscope and then not hiring as much as they used to. So the consumer is still, not consuming as they should. They're just buying low price tickets versus, versus high price tickets, and you can see that in the lower revenue. But these companies, K-Web companies, have done a great job over the past year of cutting the fat, right? Of cutting cost. You look at the EBITDA growth has been much better. Net income growth has been much better. Alibaba has a specific kind of situation here where they're going through a restructuring. Investors still not sure of which direction, when they're going to IPO, how many different units it's going to be, who's the CEO. So these are all questions. But if you look at Pinduoduo, Kuaishou, Douyin, these companies are doing really well, growing. Pinduoduo did 94% revenue growth last. So basically within that space, some companies doing better. The overall picture is the consumer is not coming back as fast as we wanted to, and that's because we want to see government focus on more demand side stimulus. We want to strengthen the safety net, provide consumers with paychecks to consume, subsidize hiring, do these kind of things that kind of actually transfer economic gains from manufacturing and infrastructure to actual consumer.
So Eswar, I want to bring you in here because as you look at some of the indicators that are showing you what's happening with the underlying economy and financial markets and the heavy lifting that the Chinese government is going to have to do, how much confidence do you think this is inspiring right now?
This is a pretty perilous time for the Chinese economy, Rochelle, because right now we are seeing deflation becoming entrenched. We see that the stock market is unraveling. The property market is not doing terribly well. Growth is slow. Employment is weak. The biggest problem, though, is the lack of private sector confidence. Households are very reluctant to consume. Private businesses are very reluctant to invest. And that's going to require a combination of things to turn matters around. It's going to require some macroeconomic stimulus, especially fiscal stimulus that more directly supports consumers. It's also going to require some measures to restore confidence of the private sector. One of the things that has really hurt confidence over the last couple of years is the management of the COVID situation, but also the fact that the government has taken a heavy hand to private sector firms in the tech sector, Alibaba being one example, but also firms in the health sector, the education sector, and so on. And during my last visit to China, there was a clear distinction between what I heard in Beijing from officials, the sense that, they were still on the side of private enterprises, and what I heard in Shanghai from many entrepreneurs that they felt that something fundamental had changed, that Beijing was perhaps not hostile to the private sector, but was not going to support it in the way it had in the past. And that's going to mean that the Chinese government has some pretty heavy lifting in order to restore confidence, which is going to be essential in order to generate better productivity and employment growth, for which it really needs the private sector.
Eswar, we have seen sort of the Chinese playbook in the past play out. You think about what happened in 2015. You had the national champions, the state-backed funds coming in and buying up those Chinese equities to try to create a floor on the market. The reporting out there suggests that's already begun. Given where the macro economy is right now, though, is that enough to bring the confidence back?
So right now, there is a confidence issue for both domestic investors and foreign investors. If you think about the multiple risks that investors in the Chinese equity markets face right now, there is the macro risk related to how the economy is doing and the short-term growth prospects, which look a little bleaker now than they did some time ago. Then there are the policy risks, how the government is going to respond to the slowdown, what sort of measures they will take to prop up the stock market and the property markets, and also what the long-term direction of policies will look like. And then for foreign investors, there is the additional risk of currency volatility, but also the geopolitical uncertainty and the possibility that the Chinese government might clamp down with capital controls to restrict capital outflows. Now, having said all this, as your other guest just pointed out, there are still some opportunities out there. If you have a strong stomach and think that the Chinese economy has decent medium-term growth prospects, then certainly you can find some good prospects. But it's going to take some very careful analysis to find the right opportunities in this very difficult environment, both economically as well as politically.
So, Anthony, with that in mind, then, what are some of the picks that you're looking at here, given that we are looking at this very uncertain, perilous time, this sort of dance that the government is doing about how much intervention it should do while still wanting some of this private and foreign investment as well?
It's a long laundry list here. Look, everything the macro is very important here to shape anything where you can invest in China. And if you look at China, there's innovation across the board, right? And we don't see inflation as an issue in China, deflation, which, and some of the negative headlines tend to overstate what's actually happening in China. So basically, it's last 2 years because of COVID and regulations, you have low consumer sentiment, okay? That's impacting real estate and unemployment. And that's impacting demand. In turn, it's impacting private investment, which we just mentioned. So basically, the government should focus more on demand side stimulus to bring back the consumer confidence, because once that's back, and it will be very shortly, the train will go back on track. Look, China is one of the major economies with a major balance sheet, ample resources, a lot of reserves, very low debt to GDP ratio, very high savings, big consumer, so all these, they're not going away. China is going to be there for the long term, but now it's going through a cycle. And if you look at it now, it's one of the cheapest globally. It's one that has higher growth, most upside in the next 3 years compared to the US, which is more overextended. So we're looking at new sector China. Our top pick is KWeb, China Internet, because these companies were hurt the most from regulations. They are very underowned. And if you look at the activity and the flows over the last 2 weeks have been tremendous, just because seeing that the government is taking the market way more seriously now, and that's usually a sign of a bottom, right? And that could bring some momentum into these companies. Also, we like the semiconductor industry. We like the green policy industry. All these industries are aligned with government policy, right? And so these are where we would advise investor to kind of focus.
I appreciate the both of you for joining us this morning. Eswar Prasad and Anthony Sassine, thank you both so much.
Thank you.
Thank you.